Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and today we're going to go over a report and data from Freddie Mac, brand new report about the housing market. And you guys, the data suggests impending doom. And one thing that really hit me like a ton of bricks is how much market share is actually going towards cash out refinance. And the thing with cash out refinance, guys, is people are essentially treating their home like an ATM machine. The interesting thing as far as market share for cash out refinances, we are at a similar level as we were during the Great Financial Collapse. So we'll deeply go into a report by Freddie Mac. They're going to summarize a lot of information, you guys. And if you don't know who Freddie Mac and Fannie Mae is, basically they're the real banks when it comes to mortgages. So before I jump into the report from Freddie Mac, I'll first explain in more detail who Fannie Mae and Freddie Mac is. But if you guys can remember, I'm not a financial advisor, even though my bio is as a father, a husband, a renter, someone that had a foreclosure, and someone that wants you to win. And for my desire for you to win, please guys, like the video, subscribe if you haven't already, shoot me a comment below. But either way, I hope you guys enjoy this video. I'll start by going to FHFA to give you guys a quick breakdown of Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac were created by Congress. They perform an important role in the nation's housing finance system to provide liquidity, stability, and affordability to the mortgage market. They're a little bit failing on the affordability thing, am I right? They provide liquidity, and that is the most important thing about what they do. They provide liquidity to the thousands of banks, savings and loans, and mortgage companies that make loans to finance housing. Fannie Mae and Freddie Mac buy mortgages from lenders and either hold these mortgages in their portfolio or they package the loans into mortgage-backed securities or MBS that may be sold. Lenders use the cash raised by selling mortgages to the enterprises to engage in further lending. So basically, you guys, lenders have to sell their loans, and they sell their loans to Fannie Mae and Freddie Mac, for example, because they can only lend for so long, right? They'll run out of money. So what they have to do, they have to lend it, they have to sell it so they can keep lending. By packaging mortgages into mortgage-backed securities and guaranteeing the timely payment of principal and interest on the underlying mortgages, Fannie Mae and Freddie Mac attract to the secondary mortgage market investors who might not otherwise invest in mortgages, thereby expanding the pool of funds available for housing. That makes the secondary mortgage market more liquid and helps lower the interest rates paid by homeowners and other mortgage borrowers. Freddie Mac was chartered by Congress in 1970 as a private company to likewise, again, help ensure a reliable and affordable supply of mortgage funds throughout the country. Understanding the secondary market and mortgage is especially important, but essentially, again, lenders need to sell and package loans up in the secondary market so they replenish their balance sheets. But not only that, they get profit from selling the mortgage. For example, say a lender gives you a mortgage, maybe they make 4%, right, upfront in fees. So the profit for just originating and closing the loan may be 4%. But when these lenders sell that mortgage in the secondary market, which is basically being sold to a servicer, right, and the servicer collects the interest, generally a lender can get 2-3% in addition to the profit selling the mortgage. So in other words, mortgages are quite profitable. This is from Freddie Mac. This will be linked in my description. This is the economic, housing, and mortgage market outlook for August 2023. So some really, really interesting things in here, you guys. Now, it's going to start by saying U.S. economic growth remains on firm ground with strong consumption spending and a tight labor market. So I can dig into that and kind of break that apart a little bit, but let's just keep going on this report. Although housing market activity has slowed, a demand-supply imbalance in the U.S. is causing a rebound in home prices. Refinance origination activity for the first half of 2023 is the lowest in almost 30 years. When I show you guys the share of refinances versus purchases, you guys are going to freak out how many people are turning their homes into ATM machines just like in 2002 to 2008. Recent developments in the U.S. economy. The economy remains on firm ground, with second quarter real gross domestic product, or GDP, growing at an annualized rate of 2.4% until they revise it. Stronger than in the first quarter, according to the U.S. Bureau of Economic Analysis. That is modestly above trend based on long-term demographics and productivity growth. Consumer spending grew at a 1.6 annualized rate in the second quarter. While consumers remain resilient in the face of interest rate and high inflation, the consumer firewall is getting weaker compared to the first quarter when consumer spending grew at an annualized rate of 4.2%. Consumers remain generally upbeat, likely reflecting the deceleration in inflation, tight labor market, and the cushion they have from excess savings accumulated during the pandemic. The pandemic recession and recovery was the first recession where consumers accumulated trillions of dollars in excess or above trend savings. While there are various estimates of the excess savings accumulated by consumers, most estimates would suggest the total savings accumulated to be greater than 2 trillion. Let me remark on that real quick. About 6 days ago, another report came out that is saying that by October, all of the excess savings will be spent. So it's fair to say, you guys, another reason for the massive run up in home prices is people were burning through that excess savings. And I also find it interesting that they think that's going to end in October, right when school loans start. Interesting. The pace of job growth is moderating, with the economy adding 187,000 jobs. Those jobs were part-time jobs. We actually lost over 500,000 full-time jobs month over month. So that's an annualized rate of 6 million full-time jobs. So just to put this in perspective, they like to leave that out when talking about the labor market. In July 2023, according to the Bureau of Labor Statistics, these job gains were led by healthcare, social assistance, finance activity, and wholesale trade. Employment in construction and financial services also increased, even as rising interest rates have adversely impacted these sectors because employers are holding on to workers. The employment rate ticked down 3.5% to remain close to a 50-year low. Holy smokes. Wage growth remained solid, with average hourly earnings increasing 4.4% over the past year. The slight easing in the labor market conditions is also evident in the employment cost index, a measure of the change in the cost of labor, free from the influence of employment shifts among occupations and industries. According to the BLS, compensation cost increased 1.1% over the quarter and 4.5% over the year in Q2 of 2023. This is a decline from 4.9% yearly growth in Q1 of 2023 to 5.1% a year ago. This goes on. Inflationary pressures have been easing. Data from June suggest a further cooling to 4.1% year over year in the Federal Reserve Preferred Inflation Gauge, core PCE. The overall prices on goods continue to decelerate, while prices for services increased. From the beginning of the pandemic, prices for goods soared, with everyone working from home and shifting their spending towards home improvement. New computers and durable goods like furniture. As the economy reopened, the spending increasingly shifted back towards services, including housing services, which are driven by rents. This is very intriguing. This is basically the golden handcuff effect. So this is a share of outstanding mortgages, and this is only going to Q1 of 2023. I'm interested to see what Q2 looks like. And specifically what I'm looking at is the right two columns right here at 9% and 10%. The reason I'm looking at that is people are trading in their low interest rates to do cash out refinances, and all of the new recent homeowners are having to get much higher interest rates. If we look to the left, we know about 81% of mortgages right now are under 5%. That is definitely a factor in the limited amount of inventory, but the share of mortgages above 5% is now sitting at 19%. And with the increase in cash out refinances and with people continuing to purchase, odds are, you guys, that's going to get much higher as we go on through the year, which could possibly lead to a future foreclosure crisis. Recent developments in the U.S. housing market. Home sales has slowed due to the 30-year fixed rate mortgage rates staying above 6.5% since May of 2023, thank goodness. Existing home sales declined 19% from a year ago, while new home sales were up 23.8% over the year. Monthly new home sales numbers are volatile and fell for the first time since February, down 2.5% over the month. And I'm going to tell you guys the reason that is these insane, ridiculous buying incentives are no longer working. And yet the market remains undersupplied given the current demand, partially due to the mortgage rate lock effect. And also I'll add the fear of missing out and the absolutely toxic obsession with recklessly purchasing a home. This lock-in effect continues to dampen the number of listings of homes for sale, as almost 2/3 of all mortgages have a rate below 4%. The inventory of existing homes for sale remained unchanged in June at 1.08 million units, down 13.6% from a year ago. The months of supply of existing homes for sale inched up slightly, this is good, to 3.1 months, still near historic lows. The inventory of new homes for sale increased last month to 432,000, representing a supply of 7.4 months, which is a buyer's market. Pending home sales, a forward-looking indicator for existing home sales, increased 0.3% in June, indicating that existing home sales in coming months might increase a little. However, contracts were still down 15.6% year over year. Very interesting data here. The Wells Fargo Housing Market Index for builder confidence continued to improve, with the index nudging up 1 point to 56 during July. However, according to the U.S. Census Bureau, housing starts fell 8% over the month and were down 8.1% year over year to register the biggest drop in a year. Permits also declined over the month of June and were down 3.1% on a month-over-month basis and fell 15.3% year over year. Let's be honest now, obviously no one has a crystal ball. We're reviewing the data, we're evolving our purchasing power and our mindset, but we all know if there is not a continuation of this toxic home buying, these new home builders are not going to be able to sell their house. And also understand that the only way that most of them are even selling their houses, they're offering fixed interest rates 2 and 3% under market rates, and they're paying closing costs. So essentially they're taking business away from the existing market because the existing homeowners, they cannot compete with those types of price cuts and those types of interest rate buy downs. The thing is, guys, to buy down a fixed rate like that can cost $30, $40, $50,000 in rate buy down fees. They're paying a lot of money to get these interest rates. And we can see that information in the finances of the builders because they're making less money now. Recent developments in the U.S. mortgage market. Despite some moderation in inflation, the Fed raised rates in their July meeting to bring the Fed funds rate up to 5.25 to 5.5% range, the highest level in 22 years. The rate hike was well anticipated and led the 30-year fixed rate mortgages, as measured by our primary mortgage market survey, to reach a high of 6.96. And right now, you guys, it's in the mid 7%. During the second week of July, before settling in around 6.8%, purchase applications declined in response to these higher rates, with total applications down 25% over the year, purchase applications down 23%, and refinance applications declining almost 30% during the third week of July, according to Mortgage Bankers Association. So I want you guys to understand that that write-up right there is not even taking into account that interest rates are in the mid 7%. So all of the stuff that they're talking about will get worse because they're talking about rates under 7% right now, and rates have absolutely skyrocketed over the last 2 to 3 weeks. So it's fair to say, you guys, as long as the Federal Reserve keeps that 2% inflation goal, and as long as the 10-year Treasury stays high, this is an environment that we need, in my opinion, in order to get back stability in our housing market. Because the reality is, guys, the average American needs to be able to afford the average house. And right now, it takes roughly $150,000 annual income to buy the average house. There's something wrong with that. And on top of that, over 60% of people are living paycheck to paycheck. And also remember, everything that they're talking about is in the front end of the recession. A recession hasn't even started. And this is before unemployment has become unhinged. If we go into recession and if unemployment gets unhinged, everything changes. Home prices. Our corporate forecast for the next 12 months has home prices rising by 0.8% and additionally 0.9% over the following 12 months. consistent with our projection of a gradually softening labor market. This is more optimistic than earlier in the year, mainly due to the rebound in prices after the house price declines in the second half of 2022. We believe the rebound in prices is driven by a combination of very tight supply and a large cohort of millennial first-time home buyers reaching prime home buying age. It is evident that despite affordability issues, there is a tremendous demographic-driven demand for houses relative to supply, which will continue to keep upward pressure on prices. We expect the labor market to gradually soften without major adverse effects on the economy. One huge thing that they keep leaving out, a lot of these people keep leaving out, one of the reasons why it appears that people are still buying houses and they can afford to buy these houses, again, is these new home builders are creating payments that are artificially much lower. They're doing permanent fixed rates. So this data is skewed. The average interest rate for a new home is much lower than the average interest rate for existing homes. And let's talk about millennial first-time buyers. 40% of millennial first-time home buyers are getting their down payment from their parents. 40%. Here's what I want to dig into, because this is going to go into cash out refinances. Refinance origination activity in 2023 has been at the lowest level in almost 30 years. In the first and second quarters of 2023, there were only 75 and 80 billion respectively in mortgage refinance origination nationally, the lowest quarterly volume since 1995. The decline in refinance activity is a direct result of higher mortgage interest rates. Since most homeowners locked in low rates, relatively few people can lower their rate now by refinancing. However, some borrowers are still opting to refinance to cash out home equity or to lengthen the loan term, as we will discuss next. Remember how bad refinancing can be, because you start the entire term over again, and the first 5 years of a mortgage is really heavily front loaded with interest. So each and every time you refinance, you start that clock over again. So not only are they trading their interest rate, they're also trading in the amount they've paid their mortgage down, and they're trading it in for a brand new amortization schedule. That could be very bad. But what can be even worse is these struggling homeowners that are cashing out are using their homes like an ATM machine. And that was one of the catalysts for the great financial collapse. Everyone was doing refinances and cashing out as much money as possible during the great financial collapse until essentially it all came crashing down. And look at some of these stats. Okay, guys, so what this chart is this is a trend for conventional prime refinances. So this is only conventional. It's not FHA, it's not VA. What I want to point out, first of all, is the total share. This is cash out share of refinances based on loan count. So the total amount of refinances are being used for what, right? So in 1998, the total amount of refinances, 48.6% of them were cash out refinances. The average person cashed out a whopping $52,000 or 17.4% of their equity. Now, let me show you guys a little bit about what happened during the great financial collapse. Now, like I said, everyone started refinancing, and we can see that right here in 2005. Basically, it went from 45% of total refinances cash out all the way to a whopping 72%. So in 2005, everyone's refinancing. The average amount of money people are pulling out, a whopping $79,000 or 19.1% of their equity. But look at what happened in 2006. It ballooned up to 86.7%. Almost everyone was refinancing. Think about that, guys. And people were pulling out an average of $95,000 or 22% of their equity. Talk about obsession, right? And I was in it, so I remember this. And look at 2007. 83%, 92,000, 22% of equity. And then it starts going down drastically. And look at 2010, you guys, only 19.3% of refinances were cash out. So let's go down and see what's happening today. What I find very interesting, guys, is similar to the great financial collapse. Most people right now are doing refinances to cash out. To me, this demonstrates struggling homeowners. And this, again, is in the face of no unemployment, school loans haven't even started, et cetera, et cetera. But look at 2022, 83.1% of the total refinances were cash out. Average person took out $77,000 or 18.6% of their equity. But now, you guys, look at this. Look at 2022 H2. This represents the second half of 2022. Look at this number. We have never had this amount of refinances used to cash out. You guys, second half of 2022, 95.7%. Hey! For an average of $84,000 or 22.7%. That's huge. That's almost all their equity. They're taking all their equity and saying, all right, wish us luck. But what's really astounding is look at the same trend is continuing in the first half of 2023 with 88.8% of refinances being cashed out for a total of $89,000 or a whopping 24% of equity. Again, I say to you, the average person that's doing a cash out refinancing is taking out 24% of equity on top of trading in their low interest rate. You guys, this is a recipe for disaster. There's a lot more details in this article. It will be linked in my description. If you guys want to go crazy and just kind of dig into the data, I suggest it. But I hope you found this very interesting. Now, obviously, I take some things with a grain of salt. I believe they're being a little bit unrealistic and they're not taking into account like very important things like massive equity run up, insane buying incentives, and the fact that when rates do go down again, there's going to be a huge increase, a temporary huge increase of existing homes for sale. So I'm going to be ready for that increase. Hopefully you'll be ready for that increase. And just because there's going to be an increase doesn't mean I'm going to buy, but it's going to give me a better opportunity to buy the home I love. No, other than that, guys, I really hope you guys got some new value, insights, and perspective. And if you're out there investing in real estate, you know I wish you luck and I hope you win.